Good evening, everyone. We are live from Chicago. Today is Thursday, March 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are with us tonight. Wow, has it been an incredible first half of the first 100 days, right? So let's see what can happen now and what happens going forward, right? A lot to talk about. If I can get my slides here to move to the next screen, it's going to really help. But right now, they seem stuck, and I'm sorry, guys. I don't think this has ever happened before. There we go. All right, so DOGE and to the tariffs dilemma. That's what's causing the majority of this market consternation. We will spend an in-depth amount of time on both of these and take your questions tonight. All right. So this is the normal topic center that we cover every session. We may not get to every one of these tonight because it's going to be a full pack show on policy and performance, the employment scenario, and stock selection at the end. A lot of feedback from you guys after the last show that you want more information on how I select stocks. We've talked extensively on how I protect you to the downside on the stops, STOPS, that I use. But I know you want to learn more about stock selection, so we're covering that too. Please subscribe to us on YouTube. Click the little bell and you'll be updated whenever we go live, which is the second Thursday of the month. But we are starting, as of last month, a mid-month, or actually end of month, since we are mid-month here live, additional program. It's not live, it's pre-recorded, but I'm going to be doing interviews and special interests and things that I hope benefit you. You can also follow me on Facebook, X, and LinkedIn. I tweet every single day. Just started this last July, and it's picking up with a lot of people following me every week. I usually do a podcast on Sunday night, and we air it on Monday. So you can see this on Spotify, Apple, Amazon, wherever you get your podcasts. So monthly, you'll see me twice live and then once pre-recorded every single week, generally, unless something happens or it's a market holiday on a Monday with the podcast, and then the daily tweets. We do our best to keep you updated, and this is the first one. You've been seeing this in promotions we've sent, but Tom Basso, I've interviewed before. This is a great interview on his trip to Singapore, and then just more comments on trading. I hope you'll go back. That was the February issue. The March issue we'll talk about a little bit later on, and we've already got shows for April and May that'll be supplemental to our live show. Okay, so the next show, Thursday, April 10th, put it on your calendar. That will be fully into spring. Isn't that about time, right? So the monthly market review, the first 100 days. So that actually happened on Tuesday, 2 days ago. This is the 52nd day of the Trump administration. And the first 100 days are pretty important. Why? Because they became essentially a critical benchmark in political American history, starting with FDR, serving as a symbolic milestone, but also a practical measure of the new president's effectiveness. Certainly, in my lifetime, there has not been any president, not even Ronald Reagan, who did so much so quickly, because this period represents an urgent window of opportunity for chief executives to capitalize on their electoral mandate, all right? And that's, of course, what he's trying to do, and create momentum heading into what's going to become, within 10 months, the midterm season. So the Republicans want to hold power, the Democrats want to take it back, at least at the congressional level. So there's no constitutional or statutory significance to this. It's more a sentimental thing, but it's become very, very important, sort of like Groundhog's Day, but with more importance than that. It's a psychological and political connotation that makes the public aware that this president is doing everything he can to do what he's promised to do. And every president should do this, in my opinion. These two men, as you well know, are taking the most heat in the media right now. Both billionaires, one elected, one unelected, the richest man in the world, or at least he was when Donald Trump went into office. Right now, that's a little teetering because of what's happening with the price of Tesla. But what does this mean? So Trump's second term, as far as the stock market goes, hasn't gone as planned, for sure. So you can see the return in the first term, and you can see where we are, and that's actually a little behind. So it's more than 10% since he came into office. All right. So the post-election bumps that many presidents get and that he got have definitely disappeared in the S&P, the NASDAQ, Tesla, and Bitcoin. And you can see on the Tesla side, Tesla stock has dropped dramatically, tumbles the most since 2020. And you can see that that's pulling down the Magnificent Seven, which greatly influences the performance of DS, which we'll talk about in just a few minutes. That's down more than 20%, the Magnificent Seven index. So what is happening here? First of all, let me put you at ease. The U.S. stock market has been, for the last 100 years, the largest market in the world, and it's going to stay that way. You're going to see more charts going forward. We are in no risk of losing that. This market is not going to crash. we are going through detoxing. We'll get to that slide in just a few minutes. All right. So you can see here on the chart, just going back to 2010, the S&P 500 is the top line, international developed markets. Now that doesn't mean third world countries in the Middle East or Africa or wherever. These are internationally developed countries like Germany, like France, like Australia, New Zealand. Okay. So the U.S. has definitely been outperforming them for the last good 15 years, and I expect that to continue. That said, Europe for the beginning part of this year is definitely outperforming the S&P 500, and we'll talk about that as we go forward. This is a really interesting graph. So wealth creation needs to follow productivity in the economy. You guys wondering why we're seeing this volatility, and it's because of tariffs, it's because of DOGE, but there's also a technical correction going on. When the S&P 500 gets too far ahead of GDP, that causes a problem. And you can see it's at a 30 or 25-year high right now. What does this mean? For us, that means we have to be extra diligent in what we're buying and to keep our stops ratcheting up close. Because it's great when the market gets ahead of its skis. You've heard that phrase. And I believe that's what's happened right now. The market is ahead of its skis. GDP is not keeping up with it. The valuations of the stocks are getting very, very rich. And you're seeing that when these sell-offs happen. All right. Add that to the geopolitical stuff, and that's why all this is happening. And this is what it turns into. It turns into the NASDAQ 100 correction. So if you go back to August of last year, you can see these pullbacks. A pullback's generally 5 to 6%. When you get to 10%, that's an official correction, and then a bear market begins when the market is down 20%. The reality is there is no exact point at which a bear market begins. And remember, there's a difference between a cyclical bear market and a secular bear market. We're in a secular bull market right now that started on April 9th, 2016. It's 2016. All right. And the market has been pretty much straight up since then. There have been dips. There was the COVID dip. We certainly had that correction in 2022, but those were short-lived, meaning they were cyclical bear markets. What I'm trying to do is educate you guys so that when you see this happening on the news, and their job is to keep you glued to their news as many hours a day as you'll watch, as many days a week as you'll watch. I'm hoping I can give you sufficient information to understand what's going on and bring you peace of mind. That is my supreme goal here. You guys have seen this chart, those of you that have watched, and I want to welcome, we have some new listeners. We have a new client, new clients and listeners in Los Angeles and Walla Walla, Washington, and Lisle, Illinois. Welcome to the show, guys. Glad you're here. Sometimes I talk fast for those of you that are new, but you can always go back and watch it again, all right? But those of you that have been watching for a while know this chart. This is 100 years. There have only been, in 100 years, 3 secular, that's multi-economic cycle. That's what secular means. 3 secular bear markets and 3 bull markets. And you can see red for bearish and blue lines and green dots there for the bullish. And we're in this turn right now where we're in a secular bull market with the average return so far about 12.3% a year, which is great. It definitely beats the average return in a bear market, secular bear market of 1.5, 2.82. All right, and you can't even show the one back in 2020 because it was a depression and really didn't pull out of it until World War II. But we're in good shape. We're just experiencing a detoxing. So we finish now with the fourth quarter earnings. This is the first quarter of the year, obviously, but when we're in the first quarter of the year, we go back and look at the earnings reports from the fourth quarter. The average return is 73%. Return, not return on investment, but the average number of stocks that beat their expectations. And this quarter, it's 74%, so it's right at the average. However, consumer discretionary, financials, and technology all solidly outperformed. Why is that important? Because these 3 sectors, along with communication services, are the most strong and therefore leading growth sectors of the U.S. economy. There are 11 sectors in the economy. Those are the 4 we count on: financials, consumer discretionary, communication services, and technology. Those are the ones. You cannot have a sustained secular bull market if utilities and real estate and materials are in the lead. You just can't. We've talked about this for years. You guys know that. All right. So 2025, I should say, performance. And why am I saying this? Because we're going to walk through this. But to be fair, we need to go back and look at 2024 and contrast that. So now I'm going to pick on this one stock here, VST. This was a big winner in CG. First of all, you can see for last year, it was right under 30% for CG, 29.45, right? We're the blue line on top. We took off at the beginning of the year. We never looked back. It was a great year. It would be great if every year could be this way, folks, but it can't. All right, VST at 2.56, you see it in green highlight there. That's 2.56 of the entire return of that 29.45 was one stock. So you would say, well, why would I ever get rid of that? Because we have risk management principles, and I date my stocks, I marry my wife, all right? Now, why I'm pointing this out to you is because let's look at this year. We're only down 4.91 plus what we're down today. So this was run yesterday. So today we're down about, I think 1.8. So we're down about 6% and change. The yellow line that you see there are the European stocks. This is the first time. Remember earlier in the program, I said we're outperforming the developed markets in both Asia and Europe. But this time we're not. So about where you saw that line break away, I added the DAX 30 ETF to CG and the Eurozone ETF. And then I doubled the size of that position. So we actually have one of the largest positions we've had in a foreign stock because it's performing well. But look at VST there. You can see it's now the biggest loser for this year. So how do we have a stock that's a loser one year and a winner the other year? Because when a stock gets stopped, all right, those of you that are new to the channel, a stock, S-T-O-C-K, is something you own. A stop, S-T-O-P, is what we take. It's an exit, it's a sell when a stock hits that certain risk level point where we're not going to risk any more of the portfolio. That's how we maintain risk control, and that's how we deliver the results we do, all right? So VST actually really underperformed when we went for it this year, and we only held it for a few weeks, and it had a terrible earnings report, and it was gone. So we keep a track, if you will, of everything that trades and what percentage of the positions are winners and losers. So the biggest profit, we want to have the biggest winner be much, much larger than the biggest loser. All right, and we need our profit to loss ratio to be about 2.5 to 2.9. I've not really ever reached a 3.0, but 2.55, considering we're in not a bear market, but certainly in a pullback, is pretty good. All right, looking below that, you'll see my winning percentage is about 38%. So this should not be new to you that have been following my show for years now. We bat about as well as, you know, the very best baseball player that gets 335 or 380. Ted Williams got 400, but that hasn't happened, you know, in 100 years. The point being, we don't need to win on most of our trades. We just take stops, S-T-O-P-S, stops and stops and stops, get rid of the stocks that are not performing, stocks, S-T-O-C-K-S, that are not performing, and we hold on to the ones that are. And that is why we have more losers than winners, but the biggest profit, 161% on that first stock I mentioned to you, the biggest loser, down 35%. Now, reminding you again, when you see 35%, that doesn't mean the portfolio is down 35%. That means that stock is, but it's not damaging the portfolio more than 1%. That's what we're willing to risk on any one stock. Okay, you can see here the list. We don't have any new winners. We still have from 24 and 22 and 23. The big winners, 11,000, 9,700, 9,400. Again, this is the benchmark account. On the right-hand side, you'll see the losses are much lower, but we do have a bunch of losses in 24 and even one in 25. There's VST. But again, compare that 2,380 loss to the stocks on the left-hand side, and that's what we're trying to do. Just because we've got new people watching, this is my benchmark account. We trade in our family office. I trade CG, Alice trades CG, and our trust trades CG. So we have multiple accounts trading CG, but only one is the benchmark, and those are my accounts for DS, for GI, and for CG. All right, and that's how we come up with this performance. Your performance should be within a few hundredths of 1% of that if you've been with me for the whole year. Now, last year we brought in a lot of new clients because they came back to us from LPL. But if you are new with us this year and your performance isn't exactly what I'm quoting on the screen, it is because you don't have the full year with us, and it's called first year variance. When you've been with me the whole year and you start with me on January 1st in 2026, your performance will mirror mine, and what I say on the screen will apply to you. All right? So, growth in income, GI, had a good year last year, about 15.5%. We would never expect this to outperform the S&P. It actually did through May, and then you can see the green line, the S&P just got on fire, and GI just can't keep up with that because it's only 60% stocks. And you would then also expect on a down year like this, it's only down 2.8%. All right, and that's because we have a balance of fixed income and alternative assets in there to reduce the maximum drawdown. Still, the drawdown is about 50% greater than it was last year at this time, but we're just entering a volatile time. But this is all about asset protection. DS was the biggest performing program last year. This is discretionary strategies. You can see the blue line totally outperformed everybody at 32%, but hold on to your seats here. If you haven't looked at your account, down 14.5% this year. That is going to happen over time. And if you're new to the program, you don't understand the strategy of how these three programs interact, CB3 at cb3.com, and I'll explain it to you. I always show this, which is the lifetime performance of DS, and you can see it's killing it. Now, the astute observer will see that we're only up 304% in 7 years. And that's because just in December, I was showing you 379 over 7 years. But this program is volatile and it can move pretty dramatically. So you have to match risk tolerance, and that's part of what I do with you on a one-on-one basis. I don't talk about that on the show because it's not appropriate when I have a larger audience trying to follow along here. So I know we all hate politics. I do too, believe it or not. I'm a registered independent in the state of Illinois. But policy does affect us, and politics eventually leads to policy, which then has portfolio impact, and portfolio impact has personal impact, and that is why we have to discuss this, whether we like it or not. This is the roller coaster that we have been on literally since an hour after Donald Trump was sworn into office. And I'm sure you guys are aware of this. You've seen it in the news. It can't go on like this. The Secretary Bessent basically said on Friday the economy is entering a detox period, and the Trump presidency has declined to rule out a recession. We're not seeing any indication of that. We're going to have a recession segment later on. You have to have 2 consecutive quarters of negative GDP growth, and we're not anywhere close to that. We are not having robust growth, but we're not negative. Okay, and we even had 2 quarters of negative growth in the Biden administration. Go back and check it in 22. But no, the economists didn't say, no, this isn't a recession. So, you can either choose the benchmarks you want, but I do use the one that's 2 consecutive quarters of negative GDP. We got to have the first one before we have the second one. That's why I'm not going to come on the air in April next month and say, oh, we're now in a recession. It can't happen that fast, okay? It's slow moving. Trump's tweeted 150 times about the rising stock market. That was his first term. He's definitely not doing it now. So are people concerned about this uncertainty? Well, look at this chart. This is showing U.S. trade policy uncertainty versus global economic policy uncertainty. In other words, us and our policy versus everybody else on the planet and their uncertainty. Well, it was just pretty calm here and picked up a little bit maybe during Obama's years and then slowed back down. And then when Trump came to town, when he was elected, you can see it spike here. And then obviously in COVID, it really did. Came down during the Biden administration, and now it's off the chart, literally off the chart. I don't even think you could measure it now, but that's just the anxiety, and it's because policy keeps changing. Markets do not like uncertainty. And literally every single day, if someone told me that, did you see we have 2 battleships heading to Greenland? It wouldn't surprise me. It would have stunned me 5 months ago. Nothing would stun me now just because of what we're seeing, and you guys are seeing it too. This is a short list of the tariffs that have been announced. So China, that's in place. China, another 10%, that's in place. Canada and Mexico, but only 10% for Canadian energy because we don't want them to shut that electricity off in the northern states. You've probably been reading about that. Major exporters, steel and aluminum. And then April 2nd, and you've probably heard him say 20 or 30 times, we didn't want to do it on April Fool's Day. But on April 2nd, they're going to start all these tariffs, and they've got it planned out all the way to November and December. Not really sure what that means, if it's even going to go into effect, because you've seen these threatening tariffs and then they get pulled back. I think it is mainly a verbal tool to enable the president to wake up the people that have been taking advantage of this country, enemies and friends. That would mean Canada, Mexico, and the Eurozone. Dramatic trade imbalance with all these countries. And basically he's saying, you're not doing it anymore. So will these actually go into effect? I doubt it. All of them. So DOGE, the Department of Government Efficiency, definitely has caused unbelievable consternation. But again, this is what the president pledged to do. This is what voters elected him to do. I realize that half of America hates this whole program, probably hates Elon Musk. I mean, I can say that because I'm seeing these cars set on fire and effigies burning and all kinds of stuff. He is an unpaid employee. I think he's getting $1 a year, and he's only going to work through July 4th, 2026, and then he's going back to his businesses, what's left of them, how he's making that work. And I guess he did have a rocket ship blow up, and then we had another delay. So tomorrow he's supposed to have his rocket take off and go to rescue those pilots. And if that happens, that gives him some cred and maybe a little reprieve, I guess, from all the criticism he's getting. But what's going on is, and you keep hearing stories. Now, does this next 6 minutes, does this really affect your actual portfolio? I think it does, because it affects consumer confidence. But I want to just bring these facts to your attention, okay? We don't have a bunch of young kids that are just, wet behind the ears and have never worked on a computer working here. He has 100 people working. It's going to get to 200. And then after the first year, he thinks it'll drop back to 150. And then eventually everybody will go away. But he has hired some pretty big feet here, pretty big players. Antonio Gracias of Valor Equity Partners has served on his board, early investor. So if you're an investor in SpaceX, you're not just, a few million. All right. Scott Coulter, formerly of Lone Pine Capital, Michael Russo. So these are major people that are going in and trying to find where the leaks are in Social Security. So Social Security, Medicare, and Medicaid represent 50% of the total U.S. budget. 50%. Add 30% more for the military, and now we got 20% to cover everything else. So it has to be examined. Each of those areas has to be examined. That doesn't mean that people that are poor, that are indigent, and that's generally what Medicaid clients are, they're going to start losing their benefits. No, it's the ones that are receiving money. And you've heard it if you watch the State of the Union, or what was the State of the Union. 150, 300-year-old people receiving Social Security benefits. They have to get to the bottom of this. It's only been 52 days. I think everyone wants the waste in the government reduced, and it would reduce our tax burdens and therefore give us more discretionary money to do what? To invest. So that's why I'm mentioning this section. I think it's important for us. So he's elevated a mid-level anti-fraud specialist, this Leland Duduk, to be Social Security's acting commissioner. Now, yes, he skipped over way more experienced people, but he wants someone to go in there to focus on efficiency. All right? The Social Security agency has been taken as a beachhead. In other words, that's where he believes most of the fraud is taking place. So Social Security, Medicaid, and Medicare are different in that two of those three are really not so much entitlements, because we have paid into unemployment and we have paid into Medicare. So we're getting our money back when we receive benefits that we've paid in for decades. All right. Medicaid is a totally freebie, and it's the fabric of safety net of healthcare for this country, because we don't allow our poor people to be out in the street. unless they're former military, but that's another thing. I digress, okay? That's not the intent. We don't want anyone to be out on the street and dying on the curb like happens in third world countries. But we do want Medicaid expenses to be used for medical expenses and not extraneous expenses. That can come from other philanthropies or churches or whatever. So that's what these men and women have been hired to do, is go in and scope this out. So just hours ago, I'm guessing you know, a federal judge in San Francisco, of all places, how interesting, San Francisco has ordered that all these federal employees have to be rehired. That's not going to happen. The Supreme Court probably will be meeting over the weekend to address this. But I don't have a say in this. I'm just watching what unfolds. I'm trying to protect your money the very best way that I can. CG right now is in 42% cash because of the incredible volatility. GI only 12% because it's a less volatile program, as you know from watching the show. But I have to react. I cannot predict. Definitely, I can't predict what's going to happen with Donald Trump as president. My ability to react is far more important than my ability to predict. I've said this for 30 years, and I'm still saying it. My ability to react quickly and smartly is way more important than my ability to predict, especially with a totally unpredictable president. All right? That's what you guys pay me to do. This is a little wordy, but I want to walk you through this. This is some research that I've done, and it's just going to explain in the next couple minutes here what this is one area that needs to be looked at, in my opinion. Okay, so most people like Medicaid. Certainly, I like having a safety net for those Americans that are citizens and are not able to provide for themselves. We don't want anybody in the streets. We want everyone to be treated humanely. Just because they don't have money, they should be able to have a modicum of care. All right? But the issue is that the particular system right now allows the states to actually make money on it at the expense of the federal taxpayers. That would be you. Every one of you listening on this show tonight is paying for Medicaid abuse. So Uncle Sam reimburses states at a percentage that they spend on Medicaid. That ranges from 50 to about 77% and depends on several factors. So for people who enrolled through the Medicaid expansion under the Affordable Care Act, that's Obamacare, the reimbursement is 90%. That's pretty high. But states have figured out how to get more than their set reimbursement by inflating the cost of the program. This should not surprise you. This is happening in red states and blue states. There are no bad states. This is a way that the states have said, you know, there's a loophole here. We're going to use this, and then we're going to capture these monies and spend it how we wish. So according to the Congressional Research Service that I pursued in the Epic Times, here's how it works. Step 1, states impose a tax on medical providers who serve a large number of Medicaid patients, and there are plenty of them. So this tax, basically nursing homes and some hospitals, let's say it brings in $10 million. The state upped the reimbursement to providers, but only the ones that serve Medicaid patients. So let's say that cost them an extra $8 million. Well, then the federal government reimburses the state the extra $8 million. So they do get reimbursed for that. And at 60% about average, that's only $4.8 million. Okay, well, what happens then? Providers come out about even if they serve Medicaid patients, but the state collects $10 million in taxes and the $4.8 million from Washington and sends out $8 million in payments. That's a net of $6.8 million, which they can spend on anything because essentially they have managed to, quote, save that cost for the government, and the federal government doesn't have any accounting on it and doesn't ask to be reimbursed, which is what should be happening because it's your tax money, and who knows how it's being spent in Mississippi or Alabama. I got to be sure I pick a state that doesn't have a client. I do have a client in Alabama, so forgive me, in Alabama. New Mexico, all right, Wyoming. The reality is we want our money to be spent where we know it's being spent. We have no idea where it's being spent. That's why these people have been called in to find this out. Questions? Let me look over. I meant to tell you that for some reason my comment screen is not working. I have a monitor off to the side, so I'm going to look over here, see if there are any comments. I'm going to get a swig of water, and we'll keep going. If you've got questions, type them in. There's about a 25-second delay. So if you type it in and I don't answer it, well, one is because I can't see it on my screen, but two, it's because it does take some time to get to me. All right. Hey, Deb. Hey, Andre. And Keith, thanks for watching, guys. All right, so the Fed's been pretty quiet, actually. Fed funds rate is predicted to come down in 25. There's been one cut. I think if this market continues, we're going to see another 25. I don't think 50, but it could happen. Depends on how much of a correction we have here in the May meeting. So there are only eight meetings a year, so there won't be another significant meeting until May, and we'll see if it happens. I think it's entirely possible that it will. So the dot plot, I like to educate you. You guys can, this is cocktail party stuff. So you can say, yeah, my financial advisor taught me about the dot plot. So there are 19 dots in every single month here. And it's the 12 Fed directors plus another 7 non-voting, but they do offer their opinions even though they're non-voting. So 12 plus 7 is 19. If you count the dots, that's what we have. So the Federal Open Market Committee projects, and they project from bearish to bullish, or they call it hawkish to dovish. And you can see the scope or the slope of these dots is going down. So 2027, even the most, let's just look at the right side. On the blue column, the fourth one from the left, 2027, you see the two dots there at 3.8%. So the dovish case is we could see a Fed funds rate at 2.3, which would be phenomenal. That's the time to refinance your house, okay? And I will, of course, be telling you about that on the show, all right? So this is what we follow. That's how we know how the Fed is thinking and projecting forward. And they're always at least 2, sometimes 3 years ahead in their projections. It's very handy. Obviously, inflation in the news here. Expectations, the Conference Board, this is a conglomerate of industry expectations, and they're seeing this spike happen, and they're seeing this spike happen, because of the tariffs. We're going to get into the whole tariffs thing in a little bit here, but folks, tariffs do not necessarily need to drive inflation. First of all, you have a choice. If an item you're buying from Canada costs $14, and after the tariffs go on, it costs $21, you have a choice. Don't buy it, okay? You don't have to pay that amount. You can find another domestic producer. Now, of course, Canada's hoping that you're going to do that. So is Mexico. So is the Eurozone. So is China. But the reality is each of those countries needs us as an export way more than we need them as an import, because we are almost self-sufficient in what we produce for our people. And that is a big deal. A lot of the news media will not tell you that. There is no forced inflation here. And I guarantee you, if I'm buying, and I'm not a drinker, I think you guys know that, but if I were buying whiskey or what is it, gin or something that's got a huge tariff on it, and it went from $22 a bottle to $41, I would go back to Miller Lite or something else. And I'm being flipped because I don't drink. But you see what I'm saying? We always have choices. Nobody's holding a gun to your head, and these importers have to pay this tax, and they then want to send it on to you, pass it on to you. But you don't have to play with them. You don't have to do that at all, because there's nothing that you should have to have from one of these countries. You might want it, but let's see how it goes, guys. All right, inflation expectation. You saw that in the previous slide. This is the inflation expectation of the U.S. consumers, and they're seeing the same bump, okay? I think this is going to quickly dwindle, and I'm going to show you that on the next slide. So look at inflation here month over month and how volatile that is. But now look year over year. And again, the news media, and I keep coming back to the screen here, guys, because my job is essentially to, detox you from a month's worth of watching the corporate media, because their job is for you to watch their station as many hours a day and week as you can to stay glued to them. And the way they do that is not with good news, happy, good news. It's with bad news and scary news. But a lot of it is simply conjured. It's not real. And they'll show you month over month inflation. Look at the blue line and how it jumps around, but look at the smooth curve when you look at the same data over the same period, but averaging it on a year over year basis. In other words, today's inflation rate looks back 1 year. What is today's inflation? It's 2.7. Last year on this exact date, it was 2.8. Oh, well, we're down 4.1% on this date. But if you do that month over month, it obviously is much more volatile. Don't follow the month-by-month data, and if they're saying it on the news, ignore it until they get to the year-over-year, if they do. As you know, we do this show on the second Thursday of the month because the employment situation is the first Friday. Not always, but almost always it's the first Friday, and so I want to gather that data, I want to process it, and then I want to tell you about it and how it affects us. So employment is a really big deal. It's one of the biggest influences on stock market prices. So you can see on the left-hand side, the change in payrolls bumped up a little bit. Unemployment rate also bumped up a little bit to 4.1. Okay, now, as Trump will say, these are not my numbers. Well, when the March unemployment comes out in April, it'll definitely be his numbers. But he can still hang to it's Biden's numbers if he wants. The broad unemployment rate, U6. Okay, so this is those that are underemployed or have given up. That's always higher than the regular unemployment rate. U3 is the unemployment. U6 is the broad underemployment. So employed part-time for economic reasons means they can't get a full-time job. All of these numbers are spiking. And then look on the right-hand side. Job cuts surged 245% in February on the federal government layoffs. Well, of course they did. There are over 2.3 million federal employees, and DOGE is trying to get that down in half. And they're doing that because we have a $37 trillion debt. But before we even talk about the debt, we have a deficit. You can't possibly work off the debt. I mean, just here, you have a credit card. Let's just make this in simple terms. All right. I want everybody to understand this. 37 trillion, but you have a $1,000 credit card bill and you're adding $100 to it every month. Well, you're sending in a payment of 75. Well, okay. That doesn't really help, right? You need to be sending in 200 or something to pay down the debt and keep your deficit spending from getting out of hand. Add about 9 zeros to that, and that's the problem we have at the federal level. All right? They just keep adding and adding to it. And you can see it's literally off the chart from back in COVID 2021. You can see the lines just go off the chart, and it's going to go there again. All right? We have 10 million workers that either work for the federal government. And remember, this is people that are on government contracts or rely on government contracts. And it's been pretty consistent. It bumped up a little bit in 2008. That would be Obama. Came down in Trump's first term, went up in 2020. That would be Biden. But it's unsustainable, and it's unsustainable because we don't have the revenues to pay for this size of a government. And that's why Donald Trump was elected. Now, they may not be going about this in a way that you like it. I get that. But the reality is something has to be done, or our kids and definitely our grandkids will live in a bankrupt country, will default on our debt, and we'll be just like Venezuela. Nobody will buy our debt, and we won't have a way to sell. And then talk about inflation, because if you can't get someone to buy your debt, you have to just print more paper, and there's the inflationary cycle, right? We want to avoid that. So non-farm payrolls, this is one of the main reports, did move up just a little bit. Okay, the survey was 160, the actual 151. So survey higher than the actual, but if you add in the rest of the areas of the economy, it did bump up just a little bit. Interesting, you can see the areas that are in growing here, healthcare and social assistance. Yeah, that would make sense. And then smaller growth in other areas, construction, transportation. But look at the bottom in yellow there. I highlighted it for you. The federal government, a negative number, and leisure and hospitality. Look on the right-hand side. I just broke that out. And that is because we are starting to see people stop spending. I'm going to put that chart up again, but I just want to make sure you understand this. When people start cutting their spending, they cut discretionary spending. You're going to cut a trip to the restaurant or the nightclub before you cut the number of toilet paper rolls and shaving cream that you buy. You're going to buy staples still, but your discretionary spending is going to be ebbed first, and that's what you're seeing here at the bottom of the screen. So recession talk, again, you heard me say it earlier. This is going to be real easy. What's causing this? This whole tariff histrionics, folks. We cannot have a recession. I'm saying it for the second time. I got the camera back on me. We cannot have a recession with 1 quarter of negative GDP growth. We cannot. We haven't had a negative quarter in 2.5 years. And even then there was 2, as I mentioned to you, but the press refused to call it a recession because we quickly pulled out of it, but technically we were in one for about 6 weeks. During COVID, we were in a recession, a blatant bear market and recession for 5.5 weeks. And then the market did that V-shaped correction. Those of you who remember me saying ad nauseum, V-shaped correction. All right. We're not going to need that this time, in my opinion. But that's really the only risk right now because we're still seeing corporate profits grow. You saw that slide earlier, right? And we're still seeing GDP rise, even though it's modest. Okay. I'm going to catch a breath here and we'll talk about economic indicators, see if I got any questions. So Andre, I appreciate you typing that. I'm sorry, I got to twist my head to my other monitor over here because for some reason my main screen's not working for the comments. Nuclear is wow. I'm going to get on camera here. I'm glad you mentioned that because the world is scared of nuclear. And because the word nuclear, that's an adjective for bomb, but it's also in front of bomb. But nuclear power is also an adjective for the most potent source of pure and clean power that we have on the planet. I remember when I was growing up in Fort Pierce, Florida, we had these 2 nuclear reactors that were put in a long time ago, and they're still working and cranking out clean power. And we need to see this in our cars, and you start to see these little tiny combustible nuclear boxes that are the size of a cigar box, or what used to be a cigar box. I don't think they make them anymore. And when that gets to be able to be put into a car and you get 1,000 miles a gallon, it's going to be crazy. We'll see how that goes, Andre, but I'm interested in that. I'm not really aiming right now for nuclear investments. I'm watching it. Certainly not going to do anything right now because it's a speculative entry into the market and in this kind of market environment. But thanks for mentioning it. I love it. So everything I've mentioned so far, I do this every show, is what's happening now. But I have indicators that I look at in the future or to make decisions in the future is what I should say. So these economic indicators are not necessarily what's influencing the market today or last month or even last quarter, but definitely could influence the second, certainly third, and likely fourth quarter of this year. Most of them are not very positive. So U.S. excess household savings going downhill. All right. Mortgages, the lower chart, you'll see that people that have mortgage rates that are greater than 6% are rising and less than 3% are dropping. And that's because people are moving. And I'm exactly one case like this. I've told you about this when I was in Nashville. You guys watched my show when I moved there and watched it still when I came back. 2 5/8 was what I was paying on my mortgage there. And here it's 6 1/4. It's gone higher than that. I'm still seeing some people a little bit lower than that if you want to do an ARM. But the reality is that mortgage rates are higher, and until we get the interest rates down, guys, it's going to stay that way. Consumer confidence is plummeting to an 8-month low. Doesn't surprise me. Again, uncertainty. Consumers don't like uncertainty. So when consumers are concerned, what do? They stop spending. All right, it's the first drop in almost 2 years. Look at the little purple line dropping down there. Not a good sign. You can see the bump that we had in 2020, 2021, and then it leveled out as soon as COVID passed on. But the personal savings rate also not going in the right direction, although we did get a bump last month. So we do want to see people saving. We want them to spend because that's what makes our GDP so strong. We are a nation of consumers, much more so than any other country in the world. So consumption is good, but if it's creating a deficit lifestyle, in other words, you're doing it with debt, that's not what we want. So we do want people saving, a little bit of a bump there, but not what I'd like. And the aftermath of people having less cash is they're falling behind on car payments. 60 days late, not good. We're at a high, a 30-year high here, 1994 to 2025. So what does all this mean? It means that GDP is going to have a tough time. We want to see GDP between 2.5% and 3%. A really healthy economy is 3%. A pretty healthy economy is 2.5%. 2% is just kind of keeping up with inflation because 2% is the Fed's benchmark for inflation. We can have some years where we're just keeping up. We don't want to go backwards, all right? So 1% GDP, 2% inflation, that's a stagflation environment. We don't want that. So 3% is what we want. If we can get this debt reduced at the federal level, reduce the debt, which has to start with what? It has to start with reducing the deficit. We have to have a balanced budget. Should we have an amendment for that? Of course we should. Can we get it? It's going to take 60 votes in the Senate to do it, guys. I hope we can. I hope we can. So AI, all right. I don't have slides for you because I have an announcement. I'm just going to talk to you face to face on this. I have hired part-time an AI consultant specifically for my firm. It's not full-time, but we're spending a bunch of hours and we're doing things like this. We're taking my stock performance since 1989 and plugging in statements and saying, what could I have done better? I mean, that's really back there. All right. But definitely really focusing on 2003, 2004 and forward, where I have more statements and I'm not just having to do year-end summaries. All right. It would have taken hours and hours and hours to do this. But with AI now, we can literally compute this in a matter of half hours. All right. It still takes time. And at the same time, I have trade journals that I do for all of my programs. We're going to be inputting those. I'm even plugging in, you guys know that I'm a music composer. I plugged in my first symphony, my first string quartet, because I want to see how thinking in that way might help me. As you know, music and the markets are mathematical. So I am using this as a self-improvement tool. Now, I know a lot of people get concerned about this. They're saying, AI is going to replace everybody. It's not. It's going to make all of us stronger and better engaged to help other people. That's what's ultimately in play with our practice. I want to help you not only grow your portfolio, but grow it with risk-adjusted performance, meaning I could just put everybody in crude oil futures and Bitcoin and hope for the best. But that would not be risk adjusted and you would see 70% drawdowns. I know a Bitcoin trader who had a 72% drawdown in 2023. Not last year, but the year before that. There's no way I'm ever going to do that. So AI has become a partner. I'm working with this consultant. I'm really excited about it. And I will be interviewing him in May. So in March, you saw the Tom Basso. In March, we're going to have sort of a health and fitness segment. In April, we're going to, and I should be saying it at this end of the show, but I'm just doing it now. We have a man from Ukraine who immigrated to the U.S. 30 years ago. And I'm thinking the Ukraine situation is still going to be going on. And he's going to talk about that. Again, this will not be on CB3 Live, but in the more extended where I can just have one topic for 30, 40 minutes. All right. So that's what's going on with AI, U.S. housing market. Only one stat to show you here, and that is that delistings are increasing. I don't usually show delistings, I show listings, all right? But delistings are increasing. Why? Because people aren't buying, all right? It's a weakening housing market. They're not buying because of interest rates. They don't want to pay up at that 6%. With an uncertain market, the headroom or the ability to, if you have $100 income a week, you don't want to spend $42 of it on your house, maybe $28. All right. And when people get above that because the interest cost is so high, they say, you know what, I'm not going to do this. I'm not going to move on. So I'm watching this. The biggest consumer discretionary item in America is our home, followed by our cars. And when this slows down, it affects the economy. So the feedback that I got, and I'm going to encourage you guys, back on camera, guys. All right, here we go. So I'm going to encourage you to fill out the form. We send this to you every Monday. Hey, did you like the show? Did you learn anything? Did you dislike anything? We want to know about the length. And I said that in the email earlier that you got in this week. A lot of people say, I just wish you'd talk longer. Oh, really? Okay. When there's a ton of stuff to talk about and I have a president that literally changes the news a half hour before the show, then I'll do that. But I think most people are probably comfortable with 45, 50 minutes. This show is going to be probably right at an hour or a little over. All right. But that's because one of the feedback items I got from you last month was, hey, it was cool to see how you select stocks. Can you go into more detail? Well, yes, I can. I'm happy to do that, and I'm going to do that right now. Stock selection. So this is CG. This blue line is CG, and the red line is the S&P 500. On the far left, it's the year-to-date return. On the middle section, it's the month-to-date return, and on the right-hand side, it's the week-to-date return. So I can see in an instant, okay, for the year, that's what really counts, year-to-date, we're 10 weeks into the year, I'm beating the S&P. Does that mean I'm up? It does not. All right. It means I'm down 3.6 and the market's down 4.09. I'm losing ground on the month, but on the week, I've really outperformed it. Why have I outperformed it? I have to ask these questions. Well, I know the answer, and you'll know if you look at your account. Normally, it has 33 holdings. It has about 18 right now, and that's because we keep hitting stops. The stocks, S-T-O-C-K-S, hit stops, S-T-O-P-S. If you're new to the show and you don't know what that is, go back to the October, September shows, and you'll see full explanations of the whole stop loss management. All right? But because we have that in place, we don't have the losses that a fully loaded portfolio would have. All right. Next thing I do is look at the individual holdings like Palantir. That's at the top there, is doing well. We've got Option Healthcare and Yum Brands, which is food chain, and Unum Group, Fox Corp, etc. And then I'll look at, so where is my performance coming from? So yes, we had a good day. This was done 2 days ago, I think, when the market finished up. Allocation and selection. So let's talk about allocation and selection. See that in the middle screen, 3 spaces down, allocation effect, selection effect. When I'm making a stock purchase, I'm buying 2 things. Well, no, you're just buying a stock. No, because that stock belongs to a sector. What if I buy a great stock in a lousy sector? I'm taking on more risk. Doesn't mean that I wouldn't, but I'm probably not going to do it because I want to take on good stocks in great sectors. I really want to have great stocks in great sectors. And sometimes I do that, like VST last year. Remember that from earlier in the show? But the very same stock was a stinker. Okay? A dog. Now, dogs are great to walk, to have there when you're watching, Grey's Anatomy reruns. But dogs do not belong in portfolios, all right? And so I'm trying to eliminate that by tracking my allocation and selection effect. And you can see on the right-hand side that we underperformed today versus the S&P 500. Those gray areas means it was just break even. So, and again, I know that I get the feedback from you guys. There's just a ton of data on the screen. It's okay. I'm looking at each of these columns and I'm analyzing the selection effect for 1 day, for 10 days, for 30 days, for 6 months, and comparing that to how the other holdings are doing. Realize that I have to take a stop, S-T-O-P, stop, when I hit that 1% loss. But I can exit even earlier if the stock is becoming a dog, all right? And this is what I'm constantly evaluating. This is what you guys pay me to do. And then I have stocks, S-T-O-C-K-S, in the bullpen. We're going to talk about that in just a minute. So this is just some of the data that I look at. So when I go to explore a stock, this is Roper Technologies, which actually ended up going into DS. I'm just showing you a screenshot here of some of the data that I look at. All right. The short interest is low. Year-to-date performance, 9% in a down market. Well, that's about a week old. Maybe it's 5 days old. So pretty amazing performance, and it hasn't been dragged down by the bear inclination. Don't say bear market, Charlie. By the correction, okay? It has not been dragged down. That to me says it's a salmon. It's a salmon that's swimming upstream. Stock market coming back downstream. Roper swimming against that. I want a strong stock like that, all right? Next thing I look at is, okay, so how is it performing over 1 year and year to date? So 1 year, Roper is the purple line. That's just the performance up and down of how it's done for 1 year. So looking back to March 13th of last year, and this updates every day, all right, it's trailing the S&P 500. That's okay because look at what it's doing as of January on the right side. It's killing it. So what this tells me is something happened at the company, and I'm not an insider trader, but something happened to turn around its prospects so that it just vaulted above the S&P 500, and I want to participate in that if I can. So the next thing I look at is, all right, the competitors, Dover, Emerson, Trane, Park Haflin. These are competitors to Ropeland. How are they doing? What's their return on equity? What's their EPS growth, their PE ratio, the percent change that they've had over the last week? These are the peers. Look in the upper left-hand corner and you'll see the peers. Is there a peer that's better? And this is where I use AI. I plug in when I get to this screen. Here's a stock I'm looking at, Mr. AI Engine. I need you to look at all of its peers and tell me if there's a better choice. But now that you know the allocation that I want to make because of the sector and the selection, which is ROP, how do I pick the best stock for my clients? That's what we're doing with AI. You can't see all of this, but you don't need to. This is an income statement. You guys have seen them before. Every company out there has one. It's all stored in my LSEG, London Stock Exchange Group monitor system. This is a really, really cool, extensive system. And I don't read this at all because it goes into AI. It's in the background and comes back to me after about 10 minutes on about 6 or 7 different stocks and says, this is a buy, because I've already told AI, if the income statement is here and the profit ratios are here and the PE ratios are here, then this is a buy. I've told it what I'm looking for, but instead of having to look at it manually, this is why I don't have 2 CFAs working for me anymore. All right, but I digress. Then I will look at what are the other companies, investment companies in America doing. And again, you don't need to look at all these data, guys. I'm just showing you what I'm doing here. This is the ownership, who owns it. Are they other brokerage firms? Are they institutional firms? Are they hedge funds? Are they individual traders? So I just want to see where the liquidity is with this stock. All right. And then finally, what is the analyst saying? We got a strong buy at 5. We got a buy at 5. We got a hold at 6. We only have 1 sell. So that's pretty good. But if you look down here at the bottom, the rating, we got a 1 star and a 3 star. So what that means is this is risky. So the people that are doing this are not real risk takers. Isn't that funny? The people that analyze these stocks are kind of bean counters that sit in, I know it's sorry to be stereotypical here, but I know because I've hired them. They just love analyzing. Doesn't mean they're traders, okay? But I want their input because I use that along with all these other inputs to make a decision on, is this stock something I want in the portfolio that I'm willing to risk my money first and your money second? And am I willing to risk 1% of the portfolio value on this pick? Now, if you're a client, I think you want to know this. If you're not a client and you're watching this, take this back to your broker and say, what's your plan? Because I'm willing to bet. I've done this long enough and I've hit the 7-0 milestone here, guys. There's very few people that have this kind of plan. Why do I have this kind of plan? Because it's your money at risk. And I have a fiduciary responsibility to you, and it's important that I give you the very best value that I can. So that's how we pick it. People will say to me, you know what, why don't you just buy 30 stocks and stay at them for year after year after year and just buy and hold? So let's just say we looked at 2015 and consumer discretionary stocks are doing great. They're the number 1 performer and we put all our money there. Where are they next year? Yuck. Okay. They're 8th. All right. But what's number 1 that year? Energy. Let's put all our, 27%. Wow. I bet it's going to do that well in 2017. Where do you see it? It's negative. All right. We could go through that whole chart. You just can't do that. Buy and hold is never buy and hold. It's buy and hope. We're looking for the salmon. Salmon swim upstream. We're looking for the stocks that even in difficult markets are going to do well, which means if the current ever turns around, that salmon's going to be like a motorboat. All right. Kind of strange analogy. I just came up with that, but that's what we want. I mean, that's what you want, right? You want great stocks and you want stocks that can weather as much of a downturn as you can. That's why when the market's down nearly 10%, you guys in GI are down 4. CG a little bit more than that, but still, you saw it on the chart, still beating the S&P 500. So, all right, guys. All right. I think that is about it. This is what we covered. You know the topics. I'm talking now. I'm giving you 30 seconds to write something in the chat. If you've got a question, if you want to talk later, CB3 at CB3.com. You know my phone number. It's on here. The next show, reminding you, April 10th. If you didn't get a chance to listen to the podcast, I am tweeting every day, but I'm putting out an audio-only podcast on Amazon, on Spotify, on Apple, usually Sunday nights, about 5-7 minutes long. and just talking about what's happened, what I'm looking for in the upcoming week, especially if it's 3 weeks before my next broadcast. You might want to give those a listen. We are getting some traction on those. So if you missed our interview with Tom, definitely check that out. And then next month, real excited to have this physical health, mental health, financial health kind of, I don't want to say it a webinar because you're not going to be attending, but you can watch me interview 3 different people in my life that are significantly contributing to my quality of life, which will be important to you because I've pledged to you guys that I plan to do this for another many years. I love what I'm doing. I hope I don't sound like I'm 70, but the reality is I am. I wasn't the last time we had a show, but I am today. I love doing what I'm doing. I'm not scared of these markets. I've been doing this 30 plus years. There's always an opportunity. You can see from the performance that we can knit our way around this histrionics in the market, and you guys are going to be fine. You're just going to be fine, okay? All right, let me check the chat over on this other monitor. Yeah, Andre, I couldn't agree with you more. It's just another technology tool. Now, I will say, when the internet came out in 1993, I remember I'm going to go back on camera. The internet came out roughly 1993 with Netscape. I sat there and just was almost frozen. I couldn't believe, I knew it was going to change the world, and it did. And I got out of writing music for TV commercials and got into web design. That's a whole other story. But you could see it then. But AI has been logarithmically faster than that. And even just the last few days with what I'm discovering with this consultant, it makes sense to work with a consultant. It's hard to even sleep at night. I'm so wound up about what I'm going to be able to do to improve not only my personal life and health, but your guys' portfolios. It's just awesome. I'm not scared of AI replacing me. I'm embracing it because I want it to help me. All right. I got another one here. Hang on. I agree with you, Doc, on AI. There's no question. We really have no idea where this is going because when you see that all these data centers are being built, regardless of what DeepSeek is in China and all this, we can see that the power of teaching machines to think the entire knowledge of the world. And you can save it that way on the internet, but Google's not going to think for you. It's just not going to be additive intelligence. It's not. All right. So AI has that potential, and it's getting better and better and better at an alarmingly fast pace. So I'll be following it. We're going to be investing in those areas where I think you guys can benefit. And that's what we plan to do. All right. Always in the show with this, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. 2 Timothy 1-7. Always appreciate you guys being here. I hope it didn't keep you too long. It looks like 8:03 Central Time, so I'm kind of on time. I said it'd be about an hour. When there's a lot of information, I feel like I need to tell it to you. I hope I didn't speak too fast. Do fill out that email. Let us know what you want. I'm here to serve you. Okay, I'm going to wake up and trade every day anyway. We bring our clients along with us. You know the drill. And you guys are trading what I'm trading in your own segregated accounts. I would do this if you weren't here, but my life would not be nearly as rich if I didn't have these personal relationships in my life. And I'm very, very grateful to each of you. Let us know how we can serve you. What about the videos do you want to see? What about on the live show do you want to see? Are the podcasts helping? Do you pay attention to the tweets? Sometimes I tweeted during the whole State of the Union, I think 15 tweets or something. Is it useful? A bunch of people said, yeah, they were following me. So just let us know. We're here to serve you. God bless you guys. I hope you have a terrific rest of March. It'll be full on spring when we come back. And I can't wait to see you next time. God bless you. I'll see you then.